Scary times ahead. Since 1871, this signal only happened now for the fourth time, and this is going to be a big move if things really develop. Guys, I'm not calling for a big sell in the market, but I believe that there will be a 5% pullback in the near term, and here are the reasons. All right, let's go. Now, first of all, disclaimer apply as usual. Now, one thing to note that this is the Shiller P ratio. Have you heard it before? Now, this came from this gentleman, all right, Robert Shiller. He is an economist and he is a Nobel Prize winner. Our most important thing is that, guys, this is the fourth time this is happening. Now, understanding the market inefficiency, bubbles, and the importance of investors, psychology in driving economic outcomes these are the things that he basically focused on. And right now, this is something that we must take a note. Now, since 1871, this has never, 1871 right here. Okay, I'm going to just show you highlight. 1871. All right. Basically, it's all right. This calculation of the Shiller P ratio has ever hit the high mark about here. That's about 33. And that was in 1929. And we all know what happened back then, whereby the stock market crashed because of the recession turns depression period. Now, it happened again. All right, right here. But this time around, it went over it about 44 back then. And that was where we all know that year 2000, the NASDAQ bubble crash. Then again, this happened again back in 2018. That was where we all know that the market pulls back when it hit about 38 for the ratio. So guys, since then, if you look at anything above 36, okay, we're somewhere around here, okay, somewhere around this area, this is the fourth time. Yes, indeed. Now, of course, does it mean that the market will crash? Not necessary, but of course, it's something to be very, very careful. And because of this itself, I go detail to find out some more important stuff for you. Now, let's take a look. Now, this is the effective fund rate versus the 10-year yield. Now, this is what happened back in the Lehman crisis, right? We know that Ben Bernanke was then the Federal chief, and he was still calling for market to be okay, all is good, but we all know that later on the market crashed down. So one thing to note is that the Fed fund above the 10-year treasury yields versus the Fed fund rate, you can see that what's happening in the real market. The 10-year yield actually was dropping during this period of time, while the Fed fund rate is holds stable. Now, usually when the Fed fund rates, the 10-year yield start to come down, right, we should see the Fed fund rate following through. But apparently itself at all those big time, apparently the Federal Reserve seemingly hold on. And of course, if you look back again, now what's happening, we're seeing that the 10-year yield is coming down, and yet the Fed fund rate is still holding up. Now, this again, seemingly is portraying or chorusing what happened back then. And of course, if this continue, you look into the diagram, we can see what happened next soon. So based on the chart the last 20 years, we can see that the thing that usually happen is that once the Federal Reserve cut interest rate, okay, you can see that the stock market come off. Once again, it happened before, but there was a little bit of upside then and the market came down. So it happened again. We have some upside in the market and then it came off. So where are we right now? We are exactly here. So with the Fed fund rate is staying still at a high rate level and the stock market is here. So I suspect that, right, there could be a pullback in the near term. And because of that, I'm going to say this, guys, this is not going to be fun because we compare this to 10-year yield. You can see very clearly that the 10-year yield has been coming down. Can you see that? Okay, so every time when the 10-year yield start to come down, right, we can see in comparison to the stock market truly take a dive. So a 5% move down, it is possible. And if the RSI now at the range high for the Dow Jones, I cannot believe that I'd rather take on the sell side than the buy side at the moment. But of course, again, with the current bullish in the market right now, it's kind of difficult to be the one that's standing to the other side. But sometimes again, by standing to the other side, usually make the big bucks. Now, if you look at this moment now, this is a very important chart. Let's take a look. Now, this is the SAM rule. Now, SAM rule has crossed the 0.50 mark. I've been covering this story the last 3 months, and I told you guys, once the SAM rule goes above the 0.5%, I will definitely do a video. And truth be told, guys, this is not going to be kidding. You can see that the last time we see this back in 2001, the stock market pulls back from then on. It happened again back in 2008. The SAM rule went above 5, and then that's where the stock market pulls back. And it happened again. The stock market pulls back. So now, guys, we're at 0.51 level. So that means that we should see a market peak at this moment. All right. I believe that the market will take a dive before the election. And then after that, maybe it got safe the war again. So this is how it works. Okay. The same rule states that when the 3-month moving average of the national unemployment rate is 0.5% point or more than its low over the prior 12 months, we are in a early months of recession. Now, this is the creator of the same rule. So, dear all, this is not going to be fun. And of course, you look at the latest numbers now, you can see that the unemployment rate is going up. Okay, something that I've been warning. And of course, the initial job claim is also moving up. So with these two combined itself, right, we all know that the Federal Reserve cutting rate this time around is inevitable. But when we see that itself, right, if it's cutting it because the economy is doing well, that's good. But what we're seeing right now is not. And in fact, the stock market now is overran the what they call fair figure. Hence, therefore, a pullback before the election should be happening in the month of September. All right. And of course, right now, the more important thing is this, guys. It seems to be we have a debate coming up between this Donald Trump and Kamala Harris. All right. If, let's say, Trump really roasts this Kamala Harris, I think that there will be some selling in the market. And of course, we all know that there's something called the October surprise. Apparently, it's right. Seemingly, at every time in U.S. election, October, something spectacular, something crazy will just happen on its own. So, of course, we all know that now in Ukraine, it's still ongoing, and seemingly now there's a lot of this undercurrent going on. So, guys, I'm going to give you the 4 figures to watch out for today before I end this video. Now, the Dow is trading now at about 41,533, right, on the CFD. So that's where we are right now. We are near the all-time high. Okay. So guys, take note. As long as the Dow stays above 41,405, there is a possibility for the Dow to go for 41,936. So which means that if the Dow do continue to go higher, 41,936 could be the next target. But again, guys, if the market do break down below 41,405, it could be a free fall all the way down to 4874. Now, this is important because that means that from where 41,405 to 4874 is about 600 points. There's a lot of money to make. Now, the thing is this, if the market do lose 40,874, the next figure could nosedive to 40,343. Now, do note, whatever it is happening over here is still not much because the 5% drop, the Dow has to hit down 39,552. Now, honestly, this will be a very good figure to buy. Yes, I repeat myself. If the Dow do come down to 39,552, I think this is a good level to buy for the recovery for the US in November election. Waiting. Let me know in the comment box. I'd love to hear from you. Guys, that will be all for today. Take note, this is something you must remember. All right. So kind of leave a comment for me. If not, share this with your friend. Scout signing off. Take care. Have a great day. Bye-bye.